Well, welcome back, everybody. We are here for our Christmas week. Last kind of sort of real trading week, Chris. I mean, pretty short-lived, right?
Yeah, this week and next week, pretty much holiday disrupted, limited volume. Be careful. Some silly things could happen, but hopefully from the direction we kind of established last week, we'll just see some drifting prices to the upside. And maybe, Nick, surprise yourselves to some all-time highs. It's possible. I mean, we'll see what Christmas brings. Markets are open until 1 p.m. on Christmas Eve, and then closed Thursday. Open Friday, but limited trading. I mean, it's just going to be a quiet week. I think if the market is establishing some direction to the upside, that'll be a good thing.
Maybe one of the most constructive things we could do, Chris, is just kind of brief a little bit of the turn of new year, talking about what we're looking forward to, what we're watching out for. Do you think that there is a good chance that you get a strong year in something other than the Mag 7 this coming year? Or do you think, like, how likely do you think it is that you just get Mag 7 continuing to do the heavy lifting?
I'm going to put that probability like less than 10%. I think the market has to do something different in 2026. I think that's going to be the difficulty, or any type of volatility we have in the market might be that exact, like, quagmire, if you will, of how the market can navigate like a little bit of a rotation without smashing the market lower on such a concentrated market cap. What is I mean, I think Mag 7 alone of the top 10 stocks is 15 trillion, 20 trillion. It's made up over, I think they climbed to like over 40% of S&P market cap is in the top 10 stocks. So I think that has to rotate. I could be wrong, but we saw the rotation in February, turned it into the trade war, saw everything recover quickly from everything tech and broader market. But I kind of want to look at sector year to date.
Keep going, Chris. I'm going to just open the door real quick with my cat.
So sector year to date, information technology leading the way, communication services leading the way. That is heavily weighted with Mag 7, as Nick said. Industrials, 1829 this year. This is year to date. Financials, 13.47. Utilities, 12.64. Healthcare was one of the worst performing sectors of the year, now 12.63. Consumer discretionary, 8.62. Materials, 7, just under 8 rather. Energy, I think energy gave back a lot of the gains in the last month or so. Still positive, 3.04. Energy is going to be an interesting story. I think what I'm going to be watching a lot for in 2026 is going to be this section right here: industrials, financials, utilities. Healthcare, I think, had its beat up time, and now it's performing well. Maybe there's a continuation there. If AI makes its way into the healthcare space in a big way and the market likes it, then healthcare might have a great time. Same thing with financials. Some of the kind of white collar disruption, AI could be disruptive in financials. Obviously trading and trading volume are portions for these investment banks, but we are deregulating and not kind of holding banks as hostage for holding bond duration and what we've seen for some of these fires that have been put out in the regional banks. I think financials actually do well from just more transactions coming if the rates are ultimately going to go lower. If there's restriction or less restriction, I should say, on what they kind of have to have protocol wise as far as bond duration and how everything goes with funding and liquidity. Added liquidity to the environment is also a good thing for financials. Industrials, utilities. The concern I have is if they are doing very, very well in 2026, and these are not. Let's say there's a rotation out of tech, out of Mag 7. And not that these are gonna underperform necessarily. I don't think you can have a healthy bull market by having Mag 7 just dump. I think they have to be steady and stable, but maybe just not the 50% upside that we saw this year after the April lows.
I mean, I think a really healthy year to be honest, what would make me think the bull market can keep going is that if next year you had Mag 7 do like 6 to 8%, and then the RSP outperform. Well, I mean, just at least the rest of the market keep up. I think that's all you need. You need the rest of the market to keep up.
5 to 10.
Yeah, 5 to 10. To not be so. I would actually agree with your concept of it. It's hard for me to just keep seeing the Mag 7 continuously outperform. And I think that they will, and if they keep going at the same pace, like the outperformance keeps going, then I think you're closer to like bubble territory where you get these giant, kind of conglomerate single companies that are, I think they're also benefiting from the 401k passive flows. They're
Yep.
getting here for that. But I do think that if you're looking for market strength, you just want to see a rotation because this expectations getting higher and higher on the Mag 7. Uh,
Hmm.
it's getting to a point where if they have one bad crack at earnings, it could tumble the whole thing. So it's almost like you want to build in that spread out. Anyways, somebody asking about gold here. Yes, gold all-time high. My goodness. We started to pull back here, and then the bulls just kind of crept back in. And this price action just looks straight up constructive. I mean, we are back above the all-time highs. This candle looks aggressive. I mean, have you seen silver? Oh my gosh, this thing is beast. Like it does not want to chill out. It just keeps going and going. I
That's
wish it would give
wild.
me a little bit of a pullback, but this thing just wants to run, it seems.
I mean, it will. I just, this is why I've said, don't be short gold, don't be short silver, but do wait for opportunities that will be presented. It's like I have no timeline on when silver is going to pull back to a moving average, but it will happen. I mean, I just did a bar count measurement on gold because, I mean, look, everything you just said about the markets and sectors, and look, we could be in this weird environment where truly things could be different. I have a hard time believing that because the market knows all of the history and things don't necessarily rhyme and act the same way. This isn't exactly going to play out like the 1990s. But somehow it's like the only thing I think would be very, very different is the companies we have leading the way are so big and they're so profitable that maybe I just like maybe all the AI spending, maybe this like race to the top. I just think that if anything, we're going to see a lot of disruption, and that all of the spending up front, just throwing money at AI, is maybe not necessarily going to be like the big ROI for investors. And so maybe that's like the narrative, and we could be talking about stuff right now, and we are going to get something out of left field that acts as the catalyst of it, whether the market goes up or down. But on gold, I mean, impressive run on silver, just won't stop. I go back to gold. I think that's October 2023 is our current bar count. That's the last time that we tested this 200-day moving average, which I think puts us up to about 560 bars. So I've got 563 right now. And the longest stretch I've seen ever in gold is back in 2009 to 11 when we got up to, we literally hit like 600 bars, like to the bar, and then dropped straight down to the 200-day moving average. So if we have a run looking like this to the upside, or even more violent to the upside, I'm just saying, don't be surprised if something turns. I mean, I would say early in 2026, because if we turn early and drop to that 200-day moving average, I mean, it's going to suck, man. I mean, that percentage right now, we've got to be close to
19%.
I was going to say 15, 20% away. Yeah.
Yeah.
So that's a 19% correction. Wow. Crazy.
I mean, that's the thing is the 200-day moving average. I mean, I personally love the 200-day moving average as sort of a longer term fair value, directional trend. So I would agree that, and I've said this for a while, when gold was actually starting to pull back, I was mentioning that, like, I still think gold is in a long-term uptrend, even if you get a retest of the 200-day moving average.
Of course.
But that, as you said, exactly right. It's not a pretty experience getting there, right? Like, especially for people who are leveraged, right? They that doesn't mean anything to them. They're like, well, if I'm leveraged long gold, even if it's in a long-term uptrend, I'll blow up my account before the rebound happens. So I think you're dead on with, be careful with your position sizing, be careful with not thinking that gold can come down just as quick as it goes up. I think you're still in a strong upward trend overall. I do prefer to buy pullbacks. I was able to catch a little bit of an entry here. I will admit this is not a huge position for me, but it's a good sized trade, and I've been able to hold on to this, and I'm just trailing a stop here. But the reason I trail a stop is because I don't know, Chris, if this thing is going to start really reversing tomorrow. And if it does, I want to capture some profits and close out of there and move on. In fact, if we close the candle, just for people who have been following along with this trade idea that I've been sharing across socials, my plan is that if we close, let's just say we close right where we are right now, what I'm going to do is I'm going to put a stop right there, at least just trim a little bit further of profit in here just to capture something no matter what. And that's just my style. I like to trail stops, just lock something in on the trade and just let it keep moving if it wants to. Because you know, gold is a dragon of a thing to trade. It could give you this move or it could reverse it quickly. And so I think the trend is still intact, but being open-minded to when a reversal happens, bank profits, get ready for, you know, kind of the reload kind of thing.
Agree. All right, I've got to bring this up.
Okay.
Japanese 10-year.
Yep.
We're at 2.08.
Wow. Jumped up again.
I mean, starting to get more and more space above. This would be your, let's see, this is Liberation Day drama, you know, March, April. So that's this year's trade war stuff. Let's go back to the unwinding carry trade in 2024. That would be in July to August. I mean, I don't know if the percentage has something to do with it. We were about 31.5% away from the moving averages. It tested the same level, ended up finding that low. I want to say similar. Here we are 31% away, found it during Liberation Day. Here we are again. I just think like this look has to mean something to somebody somewhere. But I'm reading 24%, Nick, now 31%. So when I've seen it over 30% stretched away, it did come back. If we start going higher, aggressively higher, and we get to that like 29, 30% stretch away move, I'm just measuring from current price to the 200-day moving average is about 24 right now. If we get up to 28, 29, or 30, I just will throw it out there as like maybe a cautious trade. Like the Japanese yen might be doing something crazy within like a 30 to 60-day window. That could be another, you know, like just have it on your radar for 2026. Does anything
Chris,
in the Nikkei?
Any thoughts on the idea that the Japanese 10-year yield is spiking, yet the yen is so weak?
Yeah, I mean, I know it is.
It's confusing me.
I don't know what to do with the yen other than, I mean, is there anything on the yen that looks like we should be trading it? I mean, I've said this now for probably a couple months. I was like, hey, the Swiss yen might be one of my favorite setups if we get confirmation to break this trend line and start to give us a topping pattern. I've said that since this started to break to all-time highs again at 190, 191. We have yet to make any lower lows. We have yet to break this trend line. You look at the euro yen doing the same thing. You look at the pound yen doing the same thing. Pound yen is back up above the. Look at that, look at this crap. I mean, back above the highs. The dollar yen, we're creeping up to 160 again. The dollar's been weaker, but we're back to 157 with 160 and 162 like in view. Aussie yen creeping back up towards those 2024 levels. I saw some Swiss weakness a little bit, but that was after a kind of a reset here. Maybe I need to start looking at my wave structure again on Swiss pairs. Hopefully the Swiss will continue to make higher lows or allow these currencies to make higher lows, higher highs. Euro Swiss still pretty strong bounce off 92. Pound Swiss still holding long here until like the one. I'm looking for like a 110, 109, 110 on pound Swiss. Let's go New Zealand Swiss. You know, this could be, I mean, and it's a little premature, but if this is a 1, 2, 3, I'm looking for a 4 or 5. When I get that fifth wave, like I'm out. This is going on 2.5 years of holding Swiss pairs. I get a third or fifth wave that I'm happy with. I get some profits. I'm taking everything off the table with my Swiss positions I've been building.
I've got long CAD Swiss trades I've been sitting in for for a minute, but they pay decent swaps and
they do
very little size on. I mean, ideally I would get a little bit of a bump to the upside, trend to the upside. It makes the trade a lot easier, but I think it'll happen. And you know, we'll see what happens with that. Another question for you, Chris. So Bank of Japan, I think was a pretty severe clearing event for the market, specifically crypto. Like I think that actually, I'll tell you here, just transparently, I got kicked out of my NASDAQ trade. I wouldn't mind if the market pulled back, but I have to say that I think my educated guess is that the clearing event between a really low CPI, I know some people, you know, there was some missing data in it and pointed to some holes in that, but I think last week the bulls got like a Christmas delivery in the form of low inflation and a Bank of Japan that's like, we're backing off from quick hikes in the market.
Right.
I feel like that gives you, at least my opinion, it gives you a little bit of a short term like round of good news that could fuel the Santa Claus rally. And specifically where I'm looking is like, if you're gonna get the Santa Claus rally, I think it probably comes from the same place where this uncertainty started from, which is crypto, right? So if we look at, Bitcoin, this whole Bank of Japan debacle, this whole like, rising 10-year yield on the Japanese, bonds, etc. It has been a severe negative impact to cryptocurrency. And I just wonder, now that you have cooler than expected inflation and Bank of Japan backing off, would crypto have like, what's going on here? Why is that not enough to get? And I have no position on it, I'm just genuinely curious. Why is that not enough to get Bitcoin to move?
Well, I mean, it could be. It could just be another accumulation phase of Bitcoin versus seeing a move. I mean, to me, I just drew a couple of charts. I know my charts still look pretty ugly. But I mean, this is why I said over the last maybe month, it's like, okay, we established this low here, right around the 80K mark. I could see Bitcoin having, a lot of structures kind of drawn in like this, is like this H. So you go down, you have some consolidation, then you head back lower again. But if we had a test of the low, or even a slightly lower low, but then it pops up from there, it's like, I'm looking for something divergent to hit in if we test these lows. If we just start, let's say that we test this area, this could be a reversal structure. I mean, it's all price action based to me. It's like Bitcoin looks a lot better. At this stage, I would say above like 96. Sure. If we get above 96K, Bitcoin looks a little bit more encouraging. We make a run back and get above 100K. I think the healthiness looks decent. If we, not just like test 100K and reject here, Nick. I want to see like 100K with some follow through. And now I'd say like, okay, I think that just put in a decent low. We're on the right side of the structure. If we pull back, take your swing from a low. Let's say we hit 100K or so, we take it to a high, and then we can look at some type of positioning in here. And then you're buying the low, looking for a swing trade back to all-time highs. And I mean, crypto could actually lead a pretty interesting rally in 2026 if we wanted to see it kind of get out in front of maybe some of the drama. Like I've heard not every possible, but I've heard a lot of situations of, the first half of the year is going to be struggling, and then the second half will be stronger. I've heard the first half year will be better, and the second half will be struggling. I don't know. I mean, 2026 is it truly the just don't rock the boat trade in 2026, which is nothing really breaks. It's a little bit less exciting. We don't have any major drama. It could be like a 2017 type year where everyone, I mean, it just seems like right now we're so worried about the downside. And I think you have to have some type of downward acknowledgement, some type of downward risk protection. But I think it's just, it could be a trader's year with a range. It could be a trader's year with like lackluster gains, and everyone that's looking for crazy momentum and, an index that rips up another 15 to 20% is just really not in the cards. But I
know you do a lot of, I do the same thing as you do, Chris, on the weekend. I listen to like 17 different podcasts, and I want to make sure I'm balanced to hear. I want to hear what the bears say. They want to hear the bulls say. I try and, I heard something that really stuck with me. I never really thought about this. We spend so much time going off of what you just said. We spend so much time thinking about like, what's going to happen if this thing collapses lower, and we are always sort of in this mode of like, what am I going to do when the bear market hits? Like, that's something that we spend so much time in. But it is equally, if not maybe slightly more important, to ask ourselves, what are we going to do? How are we going to survive a bull market? Everybody wants to survive a bear market, but how do you survive a bull market? Like, it's a really weird one, because you're like, what do you mean everything is easy? But not necessarily, because you can royally screw it up by getting too heavy long tech stocks right at the end. You can royally screw it up by selling too much vol at a really low VIX and then get blown out of the water when the VIX spikes to 50. Like, you can mess up a bull market just as easy. And the reason I say maybe it's more important is because, let's face it, most of the time the market's in a bull market. Most of the time the market trends up. So it is very easy. I mean, oh my gosh, Chris, for the last few years, the number of people who have just been lost in the sauce bearish in my comments section.
Oof.
Or bullish. But like, here's the thing: if you are perma anything, the problem with being perma bull, perma bear is that you're not actually listening to the market. You're listening to one side of the argument,
Right.
and just assuming, just self-confirming over and over that it's right. Like,
Yeah.
if you are a perma bear and you're constantly prepped for the bear market, ask yourselves, what are you going to do if you acknowledge for a second that the market is bigger than all of us? None of us know with certainty where it's going to go. What are you going to do if you get 3 more years of just melt up? Like, you have to be able to ask those questions. Those are hard. Like, and
Yeah.
if you're bullish, ask yourselves, what am I going to do if this is a dog water market for 3 to 5 years from now? Like, what if we just get a terrible environment and it is everything tech gets crushed? And I was the video I was watching was this guy, a big guy, talking about how terrible of a choice it was for him to 5 years ago get all into dividend stocks. And with hindsight, yeah, he shouldn't have bought dividend stocks. But with and his whole article, I was watching a video about this article, and in the article he's like, I should have just really bought Google and Microsoft and Apple, and it was so obvious. And it's like, I mean, yes,
Everything's obvious in
now it's
hindsight, man.
obvious,
Yeah.
right? Yeah, like now it's obvious, but what about the next 5 years? What if, like, that person, I've never traded in 2000, but I've done enough of my history, I've done enough of my studying of markets to know tech stocks got absolutely destroyed for 15 years. So, how are you going to survive a bull and bear market? That's what I would think is important to ask as you go into the new year.
Yeah, and we did say that the risk is really to the upside. The pain trade could be the upside. We could have another just kind of FOMO type feel where it's like, look, the market doesn't want to go down. The market refuses to go down. There's backstops essentially in the market. It is the current administration's big scorecard. I do think a big risk that maybe as the second half of the year is going into the midterms. I mean, Trump and company might tout all-time highs and make it seem like everyone should be doing so well. I will bring potential warning to I think Bank of America came out with a survey about money manager exposure, and it's like they only have like 3% cash. Like, everyone is pretty much fully invested, and households have the most exposure, and the leverage is as high as it's ever been. People are trading on margin, but at higher levels than ever before. And part of this is I realize there's going to be like maybe another angle to the story, but it's like, I get that trading is more popular. I get that it's more gamified. I get that there's more involvement now than ever before. I think that the popularity of trading is certainly options is grown exponentially since 2020. But at the same time, it's like, if everyone seems like they're exposed, highly levered, trading on margin, borrowing on that margin at one of the higher rates, that can't end well. I just don't think that ends well. And to be lucky and have like another great environment, it's like, good. It's like, I don't want anybody to do poorly. I never do. Sure. It's like, I don't ever want the markets to be difficult. But I do think that like the risk could be to the upside, because this bear narrative keeps happening, and eventually the bear narrative just stops, and then everyone is bullish, and it's like, well, yeah, obviously I'm a bit more contrarian when it's like, I just don't think we can keep riding this forever. But until it just goes back to the simple stuff, man. Until price really shows us, and here's what I'll just say on the SP500. Until price shows us that something damaging could happen. Here's how I would say I'm a little bit more skeptical. Let's say that we test 6,900. Let's say that we drift through the holidays this week and next week into possibly testing that JP Morgan pin around 7,000. Well, if we hit 7,000 and then the market finds a way to lower itself back down to 6,500 or 6,600, I would maybe look at this as a challenging environment where this could be short-term opportunities here, Nick, but it's like, I'm not getting really excited about anything. And if this is a large distribution pattern, then we probably break down at some point, and there's going to be double-digit corrections. But if we just stay sideways and eventually break and go higher, I mean, we could have like, let's say a 5 to 10% area where the market just won't go anywhere. And a lot of traders don't know how to navigate that environment. And
it's certainly a difficult one.
Yeah,
it's certainly a difficult one for me. Like my main strategy, the momentum side, not fun. However, you also know I like to sell premium. So I have kind of my two facets. I have my trend following and my mean reversion through selling premium. So, but yeah, I think you're totally right. And we've talked about this many times, but markets in the last few years, specifically, indices have been pretty trendy. And
Yep.
when you get used to trendiness, you do have to acknowledge that you can get, I mean, these moving averages, look how clean they look. They, outside of this, kind of big reversal here, for the most part, you've had pretty trendy environments. 2022 was okay, to the downside. I mean, it was follow through, but it was sort of a sharp, we talked about that sharp, V moves back up too. But when you get into an environment that is not so clear like this is not so fun to trade. This is 2015.
Yep.
This is an infamous kind of range bound. And look, if you're selling premium, if you're buying dips and selling rips, this is a dream year for outperformance. I mean, this year comes along. If you get that in 2026, man, that's an environment where if you're selling calls, selling puts, if you are buying low, selling high, again, I think a lot of people, to your point, Chris, would really struggle in this type of environment. And people who are, who have strategies that have been kind of getting, pushed to the back burner the last few years, they might actually have a turn to really outperform.
Right. I'm just looking at this one right now. SEHY, International Dividend ETF. This is a Schwab instrument. I've had this one for the last couple of years. This is another, I'm not putting a massive position on this one, but I think if I had at least, I mean, it's cheap enough that if I at least had maybe 200 shares, maybe 300 shares of this for a lot of my accounts, this wouldn't be some bad exposure, because I do think that right now the US is, I mean, it's by far the most, like, probably one of the biggest wealth generating economy / stock markets in the world. It's liquid. Everyone loves it. But the US is sitting at these really, really high valuations that will be difficult to justify moving forward. Therefore, when the international markets look like they just have to not go down, and they could probably outperform. It's very possible that Europe could just not go down and the US could just stay stable. And I think the world could do very well off of like a stable US. Everyone that's cheering for the US to go down, everyone that's cheering for all-time highs in gold and silver. I've said this before. It's like, be careful what you ask for, wish for, because if you want gold and silver to go to all-time highs, that's great for those individual trades. But I think there is still a chance that everything goes down. Like if we have a correction, we could have an everything correction, which we haven't really had that since, briefly in 2022. And then you're talking 2008. So anyway, international stocks could do pretty well. I like this one for some inexpensive exposure. I think having, maybe a 2 to 3% allocation here. I'm not saying this is going to be like, wow, international stocks did 100%. No, but if it just stayed, let's say it does 15 to 20%, while our indexes are maybe going to carve out 3 to 5 with some fluctuations of 5 or 10%. I just think, again, we go into 2026 with a questionable tail. Like, could we go down to 6,000? Could we go down to 5,500? Or could we rip up to 7,500, 8,000? And again, like talking literally 20% swings one or the other, that's difficult to position for. Therefore, I don't think you can. I think what you have to do is you have to keep dry powder and let kind of price lead the way, take advantage of opportunities, watch the VIX, sell some premium, stay out of the way, give yourself lots of room for error, and not just have like a plan A, but have a plan B, have a plan C, and have some ways where you can trade, what you're looking at that you really like, and also have some non-correlated assets that can maybe help, I guess reduce the pain if we have some crazy volatility ahead.
Yeah, I'm with you for sure. Chris, do you have another show to go to?
I do. Yeah, I do. I have another show right now.
Let me kick you out because I'm going to keep going. But thanks for coming on. Are you coming on tomorrow?
Yeah, I'll be on. So I guess the schedule was we'll do Monday, Tuesday, Friday, right?
Yep.
Yeah.
Yep.
Okay. I'll be back.
Okay, man. We'll see you.
Cool.
Good luck with your next show, man.
Thanks, man. Bye.
See ya. All right, guys. You're stuck with me for a little bit longer. Hold on. Let me just switch over. No producer today. He's out of office, had some personal things to take care of this morning. So it's just me. Give me a second to just adjust my camera. Go here. And then we'll go, where are we going? Going here. And then we're going to take off this little thing there. Boom. There we go. How's everybody doing? Hope you guys are doing well. Always good to chat with Chris. Dude is very knowledgeable. I don't know if you guys realize this, but Chris has been trading for like 25 years. The dude has been through a lot of different markets, and I think it's a wealth of knowledge to ask him questions and discuss things. And I do think that it is genuinely a good thing to be open-minded to the idea that people who have been in the markets for a little bit longer have experienced market environments that some of us have never actually traded in. Like, for example, 2022 was a pretty rough year for markets. I mean, if you traded the NASDAQ during 2022, you had a pretty ugly drawdown, 37, 38%. That is no joke. That's a serious drawdown. That's painful. And this is the index, right? So if you were long individual tech stocks, many people saw stocks that they owned go down 80%. And that's not even an exaggeration. Do you guys realize that Netflix, an incredible stock, right? Beloved stock. Do you know in 2022, that stock got waxed for 76% drawdown, 77% drawdown? Netflix. I mean, with hindsight, oh, I should have been buying Netflix shares. But the point is, what if we had gone into a larger, longer term recession? Netflix could have gone 90% down. So be careful with, hindsight. Recency bias is a very dangerous thing in markets. My thoughts and opinions are mostly that of a trend follower, meaning, to Chris's point, if this market truly shows you signs of rolling over, I'm not going to have the, let me put it this way. I'm bullish on the market because the trend is still up and because macro for now seems to favor upside. The US economy seems to be doing okay in the sense that if we go take a look at some stuff here really quick, if I go look at my indices and we look at Dow Jones, Russell, SPX, NASDAQ, they're getting good readings. Part of the reason for that, the jobs market's been mixed, not so great, but inflation has been the winning story here recently. So CPI, huge, better than expected number there. The producer price index, not too bad. PCE, better than expected. And interest rates are trending lower on the 10-year and the 2-year yield. Not so bad. I mean, that's a hospitable environment for stocks. Because why? Stocks love lower borrowing costs. They love a Fed that's printing money into the system. They love lower inflation. The jobs market may not be excellent, but if inflation is winning, then that gives the Fed the ability to just print money into this system. So I'm not going to fight that. That's a bullish environment for now. But here's the thing, to Chris and I's discussion, if you get this kind of move, like you start to roll over and what was support cannot hold as support anymore, a mistake that could be made would be staying bullish out of like spite and out of like, refusing to acknowledge what the market's doing. Just like bears, refusing that the market is going up, that's a painful trade sometimes. So my thought process is watch what the market's doing, not what you think it's going to do all the time, because if you're trying to constantly make predictions, it's difficult. What do you think about copper long-term? Matthew, good question. I was actually looking at copper here this morning because I believe Edgefighter has a bullish reading on copper. Let me check. It does. Check this out. So copper's getting a +6 score. I was actually looking at some copper miner ETFs just out of curiosity. So I'll tell you, I actually do like copper. If you are long copper, it is probably the most industrial metal choice you could go. It serves as much less of a precious metal. Silver and gold, and even platinum to an extent, precious metals, right? People buy gold clearly for like jewelry, and central banks buy it as a safe haven kind of thing. Silver, same thing. Not as much as gold, but still, it's a precious metal. People buy silver. Silver is like the middle ground, right? Silver is both an industrial and a precious metal. Gold leans heavy into precious metal, jewelry, rare earth mineral kind of thing. Copper, however, is mostly an industrial metal. It's used in wiring, which is in everything. Like everything has copper wiring in it, like all the, planes, trains, cranes, automobiles, whatever. Copper tends to do well if the global economy is doing well. It tends to do poorly if the global economy is doing poorly. Like in 2022, you can see it got nailed because people were thinking the world's going to go into a recession with all this inflation. It's going to be problematic, right? 2020, when the world shut down, copper got killed, right? So copper, in an environment in which you have a hospitable global economy, you might be a little bit more willing to bet on copper. That's the theory. So for me, with thinking that central banks are cutting interest rates, I think that for the most part, the economy is holding up okay. You have low oil prices, which I think stems for more interest rate cuts globally. I think buying pullbacks, for me personally, my strategy, I like it. So I actually like copper on the long side. Long term, I'm more of a trader. I'm kind of always in the mindset of like 1 to 6 months out. I'm not really, if I'm doing investing stuff, I don't invest based on necessarily like if jobs numbers beat last Friday, right? If I'm investing, I'm looking at themes, like themes that I think will change the world over the next 10, 15, 20 years. But that's not really what we talk about too much on this channel. On this channel, we're talking about what's moving now and trades that we can look at, because the tricky thing with investing is if something comes out of left field that spooks the market for 10 years, you could have a down market for 10 years. People never think of that because we haven't experienced it in a long time, and everybody in trading world is obsessed with the recency bias, right? Things that have been happening, they think this will continue on. But, people who have lived long enough through markets, not myself, I've never traded in 2008, 2009 type environment, but I'm willing to acknowledge that markets don't do this forever, right? Nick, do you have any active trades on at the moment? I'm long gold, and I am willing to brag about it. So I'm still long gold. I've got a decent position on this one. It's not a huge trade, but it's good. It's still a good sized trade. And I mentioned my plan for gold today. Look at that beautiful gap up here on GLD. My plan is just to trail stops further today. I'm going to watch spot price. We are closing. Looks like we're going to close. Well, depending on how we close today, but I think I'm going to trail stops here. So if I look at spot price of gold, beautiful, beautiful position. Do we have Marco coming on? Yes, we do. I think at 9:30. But anyways, how am I playing gold? Well, I'm long and just trailing, man. I'm just trailing the stop on gold. Gold was, as I showed you a second ago, bullish signal on Edgefinder, +8 score. That's a good score. So I look for any dips, and I got the dip on gold. Commitment of traders data shows institutional buying. Let's take a look at that really quick. Where's gold at? So gold in the latest one, not a huge change here, but I'll show you something else. So change in long contracts, institutions added gold longs, and they added a small amount of gold shorts. Okay, so keep your eye on these columns if you're using Edgefinder. This is how Edgefinder scores it, is it looks at the change and also the overall long to short positioning. So overall, institutions are 86% long gold. So big money is playing for a win here on gold to the upside. But do you guys realize, institutions, they don't trade how you think they do. You might know this already, but a lot of people think institutions are trading 1 minute fair value gaps and whipping out retail traders stop losses, and they have a maniacal laugh in the background behind a hidden curtain, and they're like the Wizard of Oz. No, institutions just ride macro trends, like straight up. Listen to them in interviews. It's what they're doing. They're just watching macro. They're watching business cycles, and they're just riding trends. They don't give a rat's what about your stop loss because they don't need to. If they're trying to fill billion-dollar orders, they do not care about your $50 stop loss. And they don't really look at, like, here's another thing, right? Retail traders think that institutions think like them, where they focus 99% of their time on technical analysis. Institutions don't do that. I know you might be thinking, well, how do you know, Nick? What makes you the authority on this? I'm not claiming that. Turn on CNBC, listen to them get interviewed, and you see for yourself, when you listen to these people who manage money for billionaires and millionaires and all these like wealth managers and, people who are the biggest of the big in the game, listen yourself. How much do they talk about technical analysis? And what you will find is it's like 10% of the time, 15% of the time. Mostly they are looking at business financials, the macro of the global economy. They're looking at what the Fed is doing, the real stuff. That's what they're looking at. Go figure. The pros in the game are looking at the real world stuff, not chart patterns. Again, there's nothing wrong with chart patterns. I use them myself. So I'm not dogging technical analysis. I'm saying don't overvalue it. It's the easiest trick in the book. Retail is obsessed with 5-minute candlestick pattern trading strategies, and institutions don't give a crap about that. They care about what the macro is, what the Fed is doing. It is the greatest heist of the trading space is that retail obsesses over technical analysis, and fundamentals are for the pros. Like, it's not even, I know that sounds like very gatekeeping and very like, because I'm a macro trader, I'm just saying it's the best. But I'm telling you, genuinely, go listen. The reason I got into macro was because the pros care about macro, right? So anyways, going back to where I was going with this, COT positioning, let me show you this on gold specifically. So institutions are still pretty bearish on the dollar, which is a tailwind, I think, for things like gold. But look at this. So if I go over to gold positioning over time, institutions are still very long gold. This gray line here, that's the 50% positioning. You can see that institutions have pretty much hovered in the net bullish category for the better half of the last few years. And actually, if I take a look here, you can see it's actually 86%. This 50% line, I need to look into that because that does not seem to scale. So ignore that for a second. My point with showing you this is that institutions continue to be very, very net bullish. The yellow line is what this is actually looking at. The yellow line over time is showing you that you have massive bullishness from gold. And the reason I wanted to show you this chart in the first place is that, again, remember when I said institutions aren't really looking at your 5-minute candlestick stop loss? It's because look at what their time frame is. Let's go 60 months back, right? 5 years. And institutions have mostly kept a long position in gold. And while everyone is obsessing over the 5-minute chart and the 1-minute chart and the 1-hour chart and the 30-minute chart, these guys have just been sitting in gold for 5 years. Can I show you that on a chart? Can I show you what gold looks like in the last 5 years? You didn't even need to trade it. You could have just bought it and held it. Institutions did just that. They pretty much accumulated. And while all the retail traders trade the 15-minute time frame, watching gold's every move, institutions just rode the macro trend. Crazy, right? Because here we are, the average retail trader is marking everything up. They're looking to go long, they're looking to go short. They're, racking up broker fees. Institutions just sitting in the trend, just following the macro. So again, don't ignore it, because sometimes less is more in trading. In fact, I would argue most of the time, less is more in trading. I'm a swing trader for this reason. I think I don't necessarily think day trading is bad, but I think it's harder. I think scalping is ridiculously hard. I think day trading is very, very hard. I think swing trading is hard, but it's the sweet spot between long-term investing, where I think you can do well, but you could also catch a bad 10-year period and make no returns. Swing trading is that sweet spot where you're active enough, but you're not overdoing it. That's why swing trading is just, to me, it's the best. But that's my personal opinion. Everybody has their own. Anyways, I remain bullish on gold. I think it has more upside. Institutions are long. By the way, this tool that I'm using, this is the Edge Finder. If you don't have it, man, get a copy right now. I'll tell you why. It's 40% off. It is 40% off for our holiday discount sale. If you want access to Edge Finder and you're watching here live, here's a little bit of a Christmas bonus. We'll give it 45% off. It's a one-time payment to get access. You don't pay every month. It's not a subscription into Continuum. It is a one-time payment to get access. However, we also recognize that if people need to split it up into 2 to 3 payments, we can also set that up for you so that it's an affordable monthly cost for 3 to 2 months. And that makes it just a lot easier. For a lot of people have been really enjoying that option. So it gets you a copy of Edge Finder today so that you can spend some time with it during the holidays. I'll drop a link here in the chat right now. If you message here for 45% off /pay plans, here's the link. There you go. And I'll also just change my thing below my camera. Boom. Okay. So Here's your, if you're interested, if you want to get some more information about the payment plan option or the 45% off discount, message us. I just dropped a link in the chat. And if there is, if it's easier for you, just scan the QR code. Will there be any discounts for 2026 for the Edge Finder? There will, but this holiday sale, so like full transparency, 45% off discounts are the biggest discounts that we do all year long. We did it Black Friday this year and decided, because we had people who were like, hey, can I get to the end of like December to get those funds together? We decided to expand it. But let me be like fully real with you. 45% off, that's the biggest discount that we do. If you're sitting around and you're like, I'm gonna wait for him to do 55 or 60, we won't do it. 55 or 60, like 45 is the max discount that we do on Edge Finder. And we are also offering at the time being to split that up into 2 to 3 payments. So it's like the lowest possible price you're going to get Edge Finder for. So if you've been thinking about it, just send us a message, take advantage of it. Cycling Club says he's going to miss the Christmas discount. Shoot us a message. I'm telling you, just get in contact with Emily or Drew from our support staff. They'll give you some information about it. They may be able to work with you so that you can, I don't know, maybe January or something like that, they can reach out to you. But just speak to them. They are the way to go. If you communicate with our support team, they'll get you set up. They're very good, and they're very accommodating to people's, different financial situations. If you want the product, we want to make sure to get it to you at the best price you can get it for. Thank you, Tiger. I appreciate it, man. Hey, I saw your videos. They look great. Keep going, man. That's exciting. I'm excited to see you making some content. I love listening. I loved listening to you break down Edge Finder, because I really enjoy listening to different people who use our products and how they use them, right? Because if you like using a certain tool within Edge Finder, that's great feedback to me and the team, because then we're like, okay, people like this, or the way this was explained didn't quite, it wasn't intuitive enough as much as we thought. So love the content. Keep going. What's up, man? Good to see you. Hi from Utah. Thanks for the effort on the channel. Thank you for watching. I appreciate it. Okay, so a little bit of an update here. We've got 5 minutes to the U.S. stock market opens. NASDAQ is up here. And again, full transparency, I got trailed out of my NAS position. And think about me when you're watching the NASDAQ. If you could just pray to the market gods, ask them to give me a little bit of a pullback here, that'd be great, because I'm feeling like a dummy for getting kicked out of this trade. But hey, you know what? I did okay. I made good profits. I did everything I was supposed to. I'm not going to change my strategy or rules, but doesn't mean it doesn't sting a little bit when you get kicked out of the trade. So I'm out of the NASDAQ for now, but I'm watching for pullbacks. And actually, specifically, I like the Russell. I like the Russell quite a bit. If you give me this kind of move, I'm probably going to look to get long Russell. In fact, I may actually like Russell more than I like NAS, because I think tech stocks are very pricey. I think the expectations for tech stocks are very high. And I like that the Russell's a little bit, in my opinion, it's a little undervalued. I think it has room to have a breakout year in 2026. So I like the Russell. I mean, I like all of the indices right now if you give some discounts, but yeah, we'll see. Just taking a look here, Dow Jones is pretty flat today. Tech stocks are up. I'm curious if it's a specific stock. Google's up, Microsoft up a little bit, Tesla's up 1%. Nvidia's up 1.6. So yeah, you've got just kind of a broad bounce back up here in tech stocks. And again, this is just a week where I just think you don't really want to fight it. The Santa Claus rally most years does have a good performance during this time. So just going to wait to see. I'm either looking for a pullback on NAS and Russell, or a breakout and retest this kind of move. Both of these, I may look to rejoin the trade, but I think the trend is still intact to the upside until it's not, right? For now, I think you have an upward trend taking place in the NASDAQ that looks pretty healthy. What I'd be looking for in terms of if we're going to get bearish on this market, if we're going to start to see price action fail out, then it would be lower lows, right? Failure at support. It would be breakouts through this low level. It would be breaks back through the lows here that we put in between October and November. So generally speaking, trend is up. And I just don't want to fight that. Same thing with gold. Gold looks incredible, guys. If you're riding gold, congrats. This has been a monster move to the upside. And I think the prudent thing to do here is just to continue to trail stops, to continue to to ride this one. And so that's what I'm planning to do. I'm going to move my stop loss today. In fact, this is where I'm going to put it. I'm going to just trail this stop right there, just below this prior high. I'm sorry, yeah, this prior high here, the all-time high of October 20th or so. So I'm going to continue to move my stop, and I'm going to do that really quick just while we're on the stream, because I don't want to forget to do that. I have forgotten to do that. So let me just do it really quick. So I am moving my stop loss really quickly here. By the way, if you want to get access, you can see all the trades that I'm taking also. I'm going to update this with members here in just a moment. So I'm in profit 5% from my entry. So that would put me here 5% from my entry. That is 39902. There we go. It's close right there. Okay. So once, okay, the stock market's not open up. I'll do it in a minute. Anyways, yeah, that's my plan. Is I'm going to update the stop, trail it inside of the group, and just keep riding this gold move. Because I think this, honestly, gold is going in 2026. I know it's been a monster year for gold, but look, the trend just is dominant right now. I would not be surprised if gold is up another 20-30% in 2026. I'm not necessarily saying that's where it's going. I'm just following the trend. How do you trade gold on Webull? The price number isn't the same on TradingView. It's because I trade GLD, the ETF. They're not the same price, but it is the same underlying, right? GLD, gold shares, is just a shares version of gold. Yes, it does not have the same price, but it has the same directional moves, and the percentages are pretty dang close. They're very similar, right? So if I were to take GLD here and just cross it to, there it is, XAU USD, right? So if I, same percentage scale, see there's gold versus GLD, blue line. See, they're just moving together. It's the same thing. It's just gold shares versus gold spot. Same concept. Just like gold futures may have a slightly different price than gold spot, GLD has a slightly different. It's the same thing. You don't trade it any differently because it has the same directional percentage moves. Pretty close. So anyways, stock market just opened up. Let's watch this this market, man. If it's, I might have to watch it melt away from me. And if that happens, you know what? Patience pays, man. Patience pays. That's it. We'll wait for the setup. Is the Edge Finder using commercial or non-commercial? Non-commercial only. Commercial data, in my opinion, is mostly useless because commercial data, for those who are interested in tracking institutional plays, institutions are not commercials. Commercials are businesses that are just hedging exposure. So let's just say, for example, if you are, and you can see non-commercial right here, if you are trading based on commercial COT data, the reason I would say that is pretty much useless is because let's say that you're a gold mining company, right? And your job is to extract gold from the earth. Your job is not to speculate on what gold prices are going to do tomorrow, right? Businesses, commercials, not non-commercials, but commercial COT data is just showing their hedging activity. So they're just hedging, not speculating. They're not making a directional call. They're like, okay, our resources tell us gold is going down or gold is going up. That's not what they're doing. They're just literally saying, when we pull gold out of the earth, we want to have like specific ways to hedge using the futures market. That's the whole point of the futures market. The whole futures market was created so that people could hedge their exposure to commodities, agricultural, energy, things that they were extracting as part of their business, so that if the price of gold or oil tanks while these businesses are in operation, their businesses don't go to zero, right? So commercial activity to me is kind of useless to look at. You want to look at non-commercials. Why? Non-commercials are banks, institutions, speculators, people who are studying these markets and making predictions as to where they think they're going to go, right? So, to me, focusing on commercials is almost a waste of time. But just my opinion. I know there's some people who like to look at them from kind of a contrarian perspective, because typically commercial activity is just opposite to price. If price is going up, they'll just short because they're just hedging their risk. And if it's going down, they're just buying, right? So commercials, to me, you don't even need to look at the commercial activity to know what they're doing. They're just doing the opposite of whatever price is doing. Whereas non-commercials, speculators can be going with price, they can be going against price. To me, it's far more useful to track non-commercial data. And that's why our tools probably the best in the game for visualizing non-commercial hedge fund speculative positioning. That's what we focus on. So if that is a useful tool to you, under COT data, you have 3 prongs. You have the latest COT report, the COT positioning, which just shows you the overall positioning, and then COT data history, where you can see it mapped out based on whatever you select. If you want to look at copper, Dow Jones, euro, pound, gold, silver, dollar, pound, whatever, right? If you want to look at the historical trend of what institutions have been doing, we build tools to help make that more accessible. I mentioned it earlier. If you want to take advantage of the 40% off sale for Edgefinder, I've just dropped the link here in the chat, or you can scan the QR code below my camera. Again, this is what we specialize in. We build tools to make this data easy to read so that you can add it into your trading and add more insights and confluences to what you're looking at in markets. It's what we do. We have thousands of people all over the world. And me and my team, we are honored every day to be able to do this and to share, the tools that we love building with traders all over the world. Gold is drowning. What? Drowning to the upside, maybe. This thing's just been riding higher. I mean, I guess maybe if you're staring at a 5-minute chart, but no, I mean, the trend looks very strong here. I'm just trailing stops. If this thing does decide to roll over, I'll take profits on this move. But I think you've just had a nice, steady overall upward trend. And this is personally why I don't touch the 5-minute or the 15-minute chart, is because personal opinion, it's a whole bunch of noise. It's a whole bunch of noise because you can stare at this and to me, it's like, look at the big picture. This candle, look how smooth these charts are compared to, I mean, the 5-minute is it's just a mess, in my opinion. To each their own. Some people really love trading the lower time frames. Nothing wrong with it if you found something that you like. But to me, that daily chart is king. Daily chart is absolutely king. It's just clean. You can see what's actually happening. There's a trendiness to this gold price. I mean, for the most part, look how clean that trend is, right? To me, that's very tradable. Whereas if I am staring at a 5-minute and you're just getting these constant, back and forth fake out moves, it's just noisy. No wonder the stats just heavily favor swing trading, position trading, and investing over day trading and scalping. It does not mean, I'm not saying that you cannot be a profitable day trader, but ask ChatGPT, ask Grok, ask Gemini, whatever your AI of choice is. Is it easier to position trade and swing trade, or is it easier to day trade? What are the success rates? And it will tell you the stats are so against day trading and scalping because there's a whole bunch of noise and you're paying the broker a ton of money when you day trade and scalp. You're spending so much on broker fees. Whereas with swing trading, your activity is much lower. Brokers love, and again, there's nothing, brokerages there's many honorable brokerages businesses, but they make their money from activity. So they love day traders and scalpers because they're just constantly feeding money to the brokerage. Whereas if you're swing trading, you're a less attractive asset to the brokerage because they're taking slices off your activity, right? I mean, I know, give me my flowers here for just a second. I've been doing this for a long time. I've spoken with all sorts of far more impressive traders than myself. Most of them are swing traders. I know like a couple day traders who I'm like, oh, they really actually make consistent profits and they can prove it. But swing traders, I know tons. I know tons of profitable swing traders. It is straight up statistically more likely that you'll be successful in swing trading than day trading. Still hard as anything to become profitable at swing trading, but gosh darn near impossible to become a profitable scalper. It is so difficult because let's just say that you're, I mean, like, look, we just talked about like, oh, look, gold's going down. Like, it's just noisy. It's just very noisy. So anyways, when you scalp, ready for this? When you scalp, also, I think we have, let me just check the layout today. I want to make sure if we have another person coming on. Oh, Ivan is no longer coming on. Okay. Let me just send. Okay. Anyways, if you're scalping, right? Like if you're looking at the 5-minute candle, this is your cost for the trade, right? If not more, like your spread is costly. So every time you take a trade on the lower time frames, first base, like let's say you're just looking for this move. Well, you're paying like 1/3 of the move right off the bat to the broker, no matter what happens, because you're paying spreads, right? The bid-ask spread is what's costing you every time you enter and exit the trade. When you're swing trading, that bid-ask spread is meaningless practically. It's very small, right? But it means that spread, that bid-ask spread, is everything to a scalper. It's a substantial drag on performance because you're doing that multiple times a day. Like mathematically, that's why scalping and day trading is so dang hard. You're paying the broker an arm and a leg. So, you know, need massive capital for swing trading. If I'm trading GLD, I need $300 to $400 in an account to trade a share of this. That's not bad at all, right? And, you know, that's very manageable. Now, if you're trading futures, if you're trading CFD platforms, yeah, it gets costly to swing trade. I get that. That's why probably a lot of people day trade, is because swing trading on a CFD brokerage is super costly. Do you trade CFD? No, I don't. I can't. I'm in the US. It's illegal for us. I trade through ETFs. You can also trade in the US through futures. I just like ETFs because I trade sector ETFs, like healthcare sector, industrial sector, semiconductors. Like beyond just the indices, I like trading sectors and I like trading industries. And so I like to have it all in one account, and I really like to trade individual sectors. So, you know, real estate, et cetera, like that to me is my sweet spot. I really like looking at individual sectors and ETFs. So it's what I trade. I trade ETFs. That's the primary thing I trade. When I'm trading gold, I'm trading GLD, which is an ETF. When I'm trading NASDAQ, I'm trading QQQ, you know, which is an ETF. So, but I know people outside of the US can't trade. Not all other countries can trade ETFs the same way. So I understand if you're trading on a CFD brokerage or a futures brokerage, et cetera, you just kind of have to roll with the punches. There are some advantages. You know, in the US, let me tell you this, in the US, trading Forex kind of stinks. Like there are some, like, I am a big fan. I've traded with Oanda for a long time. Well regulated. They're a very honest business. I've worked with them for years. I've been a customer, and now they sponsor some of my stuff. I'll tell you this, they know just as well as I do that one of the biggest downsides to US Forex trading is the FIFO rule. The FIFO rule, like everybody has their pros and cons wherever you trade, regulations, etc. In the US, you can't really hedge with Forex. Really frustrating. So let me give you an example, and you guys let me know, like, if this would impact you. So let's say I'm looking at euro dollar, and let's just say for whatever reason, let's just say I decide to go short. Okay. FIFO rule says first in, first out. So if I go short here, this is my first short, and let's say price comes up here, I take a second short, and then I take a third short. Okay. So this is the disadvantage of US Forex trading. If this happens, I have to trade and close. If I want to close out trades, I have to close trade 1. I cannot trade close 2 until close 1 happens. It's very annoying. It makes a lot of like dollar cost averaging stuff, robots, automated trading systems harder in the US. It's something we have to fight as US traders. If you're, it's the FIFO rule. It's US government regulation, from the CFTC or whoever. I don't even know the, whatever the rule was or law that passed. But if, let's say I'm in 3 trades short on euro dollar, just as an example, if I want to trade if I want to close any of my positions, I have to close this one first. It's very annoying. The other thing is, ready for this? In the US, if I'm short, let's say I have a sell trade on, I cannot have a buy trade on in the same pair. So hedging is not allowed either. And it won't let you. The brokerage simply will deny that request. They're just doing what they're obligated to do legally. But like if I'm in a sell trade, let's say I'm in the sell trade and I want to, I want to do some hedging. So I want to like buy 1, sell 1, let's say I sell 2, like, let's just say we have some sort of complex hedging strategy. You cannot do that with US Forex brokerages. Very annoying. So there are some workarounds, there's some ways to, but my point with showing you that is that I know some traders are like outside the US, they're like, it stinks that we can't trade ETFs as easily. I get it. Figure it out, whatever it is for you, whatever your alternative options are, whatever your roll with the punches, wherever you trade. And if you hate it that much and you're serious about your trading, move to a place you like better. Go to Dubai. I feel like they have the least restrictions. Actually, I don't know. I don't know if you can trade. Somebody more educated on this. Can you trade ETFs in Dubai? And you know what? What's going to happen? We've got Marco here taking over the stream in just a second. You know what's going to happen? Eventually, this is my prediction, the crypto world is going to make everything tokenized. So you can trade ETFs regardless of, government regulations, et cetera. You'll be able to trade with tons of margin outside of government. But the problem with that is you better make sure you really trust the crypto exchange that you're trading on. But I bet you that's going to happen. I bet you they're going to, tokenize everything. They're already doing it in the stock market world. They're tokenizing stocks on the blockchain. Like you can trade stocks via crypto, which is, it's the future, man. Thailand. Yeah, maybe so. Yeah, maybe I'll just get a second home in Thailand and, travel out there for half the year. I'm just kidding. Anyways, guys, we've got our next show host starting. Don't go anywhere if you are looking for some more free education. Up next, we have got Marco. Also, by the way, I mentioned Oanda. I don't want to say in any way anything bad about Oanda. I've been a happy customer of theirs. I know that US regulation limits what they can do in terms of like the FIFO order, but I still trade them. I found workarounds in my own Forex trading. If you're in the US, consider checking them out. They're a sponsor of my channel. And they are quite exceptional. I mean, if you're going to trade on a regulated brokerage, whatever it is. So check it out. Here's a quick promo from Oanda. Give them a shot. I'll drop a link here in the chat for you to check them out. And then up next, we have Marco just after this quick break. Stay tuned. If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
Hello everyone, so welcome to my segment of the stream. I hope everyone is doing well. So 2 trades that I have opened on Friday, just to give you a quick update. NZD USD Aussie USD running quite nicely on this Monday. So it looks like the dollar is heavily underwater. DXY, yes, dollar is definitely heavily selling off. By the way, both of these trades were a signal in the A1 Discord. So if you want to join the A1 Discord, link is in the description of the stream, and you can use the code Marco to get a nice discount. So what's happening today other than the dollar losing value? Quite a lot, actually. I didn't expect so much movement. It is now the 22nd of December, end of the year. The big hedge fund managers, pension fund managers, big whales, big players, they are starting to go on holiday, as are we. Of course, they're all human. So as they go on holiday, as the big banks close for Christmas, New Year's, the volatility, the movement, the momentum dies down. Just a normal seasonality occurrence. But we have had quite a lot of activity. So gold is at all-time highs, just piercing higher, closing the daily candle far above the previous all-time high. Looks pretty crazy. And the stock market is up as well. So pumping higher, Santa rally maybe in full force. I think the Santa rally, I did some more research, and Santa rally is actually the last 1 to 2 weeks of December. So usually last 1 to 2 weeks of December, you get the Santa rally where the S&P, NASDAQ, they all appreciate higher. We may be getting that here. You can see from Thursday, Friday, and now Monday, we have just been shooting higher. But overall, we are still inside of this kind of a range, flat range, or you can say it does look sort of like an inverse head and shoulders pattern. So, and no, I know how it looks like. It's not what you think. It's a left shoulder and a head and then a right shoulder, inverse, okay? So this is a bullish pattern. Your neckline is, or not the neckline, but kind of the breaking line is here, and you're starting to build pressure below that line until you finally break out higher. So this is definitely a bullish pattern. But we need a breakout. We definitely need to see a breakout. Do I personally believe that we will break out by the end of 2025? I don't think so. So I think we can go a bit higher, but I don't think we're going to pierce into the all-time highs. We would need quite a lot of momentum to go into the all-time highs. And overall, as I mentioned, price still looks a bit flat, still looks a bit corrective overall. But I'm loving this potential Santa rally. Hopefully it goes up. If you want to check the seasonality, you can do so here. Seasonality scanners, monthly seasonality, S&P. November and December are usually great for the S&P and also for the NASDAQ. By the way, most of my trades, if I'm looking at the indices, most of my trades get executed on the NASDAQ. This one doesn't look as good. So we had the recovery on Thursday, but we are nowhere near the all-time highs. To hit the all-time highs, we need to go up 3%. That's quite a lot. So that is definitely quite a lot of percentage, and I don't think it's going to happen in the next 2 weeks. I think the volatility is going to die down, momentum goes down. You would need to see a lot of buying for this to go up. So the S&P looks a bit better, and there has been a rotation. If you follow the stock market, there has been a clear rotation out of AI and out of technology stocks. So out of NVIDIA, Palantir, Oracle, what do we have? Microsoft, I think even that. So most stocks that are tied to AI have been losing value lately. The money has been going into, I think, other sectors. So energy, healthcare, and stuff like that. So the S&P is doing a bit better than the NASDAQ. That's my main point. Although there has been a rotation, looks like most of the funds are still concentrated on the S&P 500 companies. But the technology sector has been suffering a bit. So what is my prediction? Am I looking to take buy setups on the NASDAQ? Because I'm focusing on that one since I think it has the most momentum, most movement, most percentage. I'm not looking for anything right now. I'm waiting for the story to clean up a bit for 2026. So I'm waiting for some cleaner, let's say, direction. If we stay in this range, so if we stay inside of here, it's kind of a no man's land, if I'm being honest. the hype around artificial intelligence has died down a little bit. If you look at the new Time Cover magazine, so let me see that Time Cover 2025. This is it. Oh, come on. This is it. Okay. So the architects of AI. Usually, this is a funny picture of Elon Musk. Usually, if something is on the cover of the Time magazine, it's a great contrarian indicator because it kind of explains that all of the hype has gone mainstream, that everyone who wanted to buy already bought, and now it's time to take some profits on the specific trade. So this is a good contrarian indicator. It worked great in the past. That's why I think in 2026, possibly AI will not do so well. It's kind of the same thing with Bitcoin, as you had the huge push higher, for example, in 2018 and 2021. Where's my Bitcoin? So you had some huge movement, and then it goes into the newspapers, and then everyone knows about it, and then you eventually have a crash. So usually right around the top, the hype is the most powerful, or here around this top. So usually you get news articles, headlines, like on the TV, you get a lot of stuff about Bitcoin, and then that's the best time to sell your assets and to cash in on the current profits that you have. So that's why I think the Time magazine cover is kind of bearish for the NASDAQ, but I'll see. I'll think about it. I'll do some more research. Of course, I'm not going to sell. I definitely am not looking to sell it, but maybe we can get a bit of a reaction, correction, bit of a pullback. And of course, if price action decides to break out higher, then I'll be a buyer. I mean, there's no sense for me waiting for a dip, a correction, if the price is super trending, looks super positive, looks super healthy. That's just not like a good trading decision. So that's my game plan: waiting out the situation and waiting for a breakout higher into new all-time highs, which is going to happen sooner on the S&P. S&P continuing to pump up higher, which is good for my DNA account because I have a buy position on the SPX, and it's currently running $900 in profit. So love to see it. Hopefully this can go a bit higher. I do have a take profit set on that one. And I have a buy on the euro dollar, which is also running in some quite healthy percentage. Okay. By the way, if you're looking to get funded, expand your trading capital, DNA Funded is a great option. So there are professionals behind the company. It's not a kid in a basement, as I always say. They're not going to disappear in the next 5 to 6 months. They are the direct competitors to firms like FTMO, 5%ers, E8 Markets. But what's great, two things that I love about DNA. First, you get, I would say, the best price out of all of the best prop firms with the code A1Live. So A1Live gets you 25% off any challenge. So that's the first great thing about it. Second is they're using TradeLocker. And TradeLocker, from trading this account right here, is by far the best platform I have ever used. For most other platforms, I need to always manually calculate the lot size in the position size calculator, which takes 5 minutes in total across all of my accounts. While in TradeLocker, I just put in, I want 1% risk. It does all of the lot calculation automatically. Boom, that's it. You execute. And it's a super user-friendly application experience, so I love it. If you want to check it out, A1Live gets you 25% off any DNA funded challenge. This is my personal 50K two-phase funded. I'm in drawdown. You can see the current equity. I'm climbing out of it, or trying to climb out of it. And this challenge is traded purely by ChatGPT, which is kind of for a YouTube series that I'm doing. It passed phase 1, 10%, passed phase 2, made 5%. Now it's time, and failed 0 times. So this is still my first account, and now it's time for the funded stage. So hopefully I can get a payout. We will see how it goes. You can tune in on more live streams to get an update on the whole situation. So we have gold. For gold, so we kind of covered the stock market. You know my plans now, especially my plans for 2026. Gold, I still love. So gold, if gold gives me an entry, I'll be looking to buy. First thing I know is that on the top setups, silver is getting a bullish reading. Gold is getting a bullish reading as well. So that's great to see. Let me see. Trend, seasonality, commitment of traders, PMIs, retail sales, CPI, PCE, interest rates, unemployment, and the ADP. So it looks pretty nice, looks pretty good to take a buy position. Now, as far as the price action goes, we have just hit all-time highs. New all-time high is 4429. So we are closing above the previous all-time high for now. That's at least what I can see on this daily candle. It is a live daily candle, so this can still close below the previous all-time high, but so far it's looking healthy. Now, I'm not the one to be getting in at the all-time highs. I'm not the one to be chasing the price. It doesn't fit my personal trade plans. So what I need to see is I need to see a pullback, a bit of a correction, to go back to, let's say, the 20 MA. If we get a pullback, go back close to the 20 MA, I'll take a limited risk position and I'll look to buy gold. So that's my game plan. Get in on a bit of a pullback, and then get in with a tight stop loss. I have an alert set. We can maybe move it a bit higher. Let's leave it. I was talking about silver. So silver was super interesting to me at this point, around this level. I tried to take a position, got stopped out prematurely. So unfortunately, if this trade didn't stop me out, it would be a massive runner. Happens. Right now, it looks crazy. So it looks super explosive, parabolic, looks like Bitcoin, looks to be full of speculators. And one thing I know, when you see this sort of price action, when the correction happens, when the pullback happens, it's going to be a big one. So 10, 15% for sure, you can expect it. One more thing that I know is if you look at all of the years where silver made more than 100%, this is one of them. So if we measure from January, 133%. So if we look at all of the years when silver made more than 100% in that year, usually the year after that is neutral, so break even, or maybe even a bit negative. Not a good sign. That's what the probabilities are telling us. That's what the historical data is telling us, that 2026 will be break even or maybe even a bit negative for silver. So I'm focusing on gold right now. I think there's a bit more opportunity in gold. Gold doesn't look as crazy, as impulsive. It went up this year massively, but it's not 100%. So it's up 68%. That's still a huge amount. But I would say just the price action looks a bit more tame. And I think gold is a bit of a smarter buy. It doesn't look to be full of crazy speculators, crazy investors that are just buying because it's going up. It doesn't look like Bitcoin in 2018, while silver definitely looks like Bitcoin in 2018. Just my 2 cents on the topic. And it's on my watch list, so I'm actively looking to take a buy setup. USD, Aussie USD, I took last week on Friday. Currently running in some pretty decent percentage. Love to see it. Looks great. Main reason why I took these positions, 2 main reasons. First reason is the RBNZ, which is the Central Bank of New Zealand, has flipped from being dovish to hawkish, meaning from cutting interest rates to possibly hiking the rates in the future. So cutting rates is bearish, hiking rates is bullish. So they went from being bearish on the currency to being bullish on the currency. RBA, Central Bank of Australia, same thing. they're expected to be hawkish in 2026. So they're expecting to hike the interest rate. That should be bullish for the Aussie. And I've paired that with the US dollar. Why? Well, because the US dollar is one of the few currencies where we expect rate cuts in 2026. Okay, I know that by going to the Fed Watch tool. So in the Fed Watch tool, if we look at December 2026, you're going to notice there's a 30% chance that we will have a 50 basis point cut. So we'll go from 350 to 300. Most likely, the Fed will cut rates in 2026. So that's a clear divergence. That's a clear opportunity to buy the New Zealand, sell the US dollar. Buy the Australian, sell the US dollar. See, clear divergence in central bank policy. RBNZ is looking to raise the rates. USD, Fed is looking to cut the rates. So this is a clear divergence. Let me see. Okay. Second main reason why I took this position, it has to do with this report. It is the 2026 outlook by specific big world banks. So essentially 12 of the biggest banks in the world, Barclays, Citibank, JP Morgan, and a lot of other banks, big banks, this is their outlook. So look at this. Most of them are bullish on the Aussie. There's a plus, so most of them are bullish. For the NZD, most of them are bullish with two minuses. So Barclays and this WF1 is negative as well. That's good. That's not that bad if you pair it with the central bank confluence. So because of this report, I'm pretty bullish on the Aussie. I'm pretty bullish on the NZD. One more thing, one more little secret is when banks put out their projections for 2026, when they put these sort of documents out, usually they get into these positions in January. So I'm expecting in January 2026, as the big bankers prepare for the new year for 2026, they're gonna load their portfolios with what you can see right here. So they're gonna buy the Aussie, they're gonna buy the New Zealand, and I'm expecting some bullish momentum in January. So that's another benefit of why I'm liking these positions. By the way, this report is from Brent Donnelly. So he has a free newsletter every Friday, which I highly, highly recommend you guys read through. It's absolutely free, and you get these awesome charts, and it's a big, big confluence to take positions. So yeah, check it out. Have a read through. What is the game plan here? What is the end game? End game is to trail my stop loss. If price wants to continue going higher, for now, I don't have a take profit set. I will be trailing my stop loss if it goes higher. It's already running an okay profit. It's not like huge, but it's still positive. So that's good. Hopefully it continues pumping higher. It is a bit of negative swaps. For example, if you look at the Edge Finder, the carry trade scanner, NZD USD is unfortunately a negative swap if you're buying. AUD USD is again a negative swap if you're a buyer. So that's a bit of a problem, but it's not a huge swap. Like it's not like you're selling USD JPY. You know what's expensive? This is expensive. Selling USD JPY. Now that's a bad, not a bad trade, but it's an expensive trade to hold. By the way, just want to talk about this. Last week, we had the BOJ, Bank of Japan. They hiked the rate from 0.5 to 0.75. So they raised the interest rate, but it's all about the forward guidance. So it's not about the number. If the number comes out the same as the forecast, the number is not going to move the market because it's priced in. It has been priced in the last 2 to 3 weeks, right? The movements in the last 2 to 3 weeks were there to price in the upcoming rate hike. So if the number comes out the same as the forecast, it's about the future projections. It's about the forward guidance. And you know what the forward guidance was for the Bank of Japan? It was dovish. So they didn't want to commit to future rate hikes. They are not really interested to battle with inflation. If we check out the Edge Finder and we go to the CPI, for Japan, it's elevated 2.9%. That is definitely elevated inflation. That's definitely a problem. But the BOJ is not interested to tame the inflation. That's considered to be dovish. By the way, if you want to get the Edge Finder, you can do so with my code Marco. So the same code that works for the A1 Trading Discord works for the Edge Finder as well. You can get a nice discount. I use this software every single day. It is a crucial tool in my analysis of data. So I highly recommend you guys give it a look. My favorite thing to look at is the GDP trend, CPI trend, meaning inflation data, unemployment trend, and the scanners. So for example, look at the Aussie. Pretty bullish, looks pretty good in the short term, right? Aussie looks pretty nice. Most of the data is coming out better than expected. What is new about it, just to give you guys a look, macro scanners, real yield heat map. This is a very, very long-term look that you can see. And if you are looking to structure kind of a longer-term trade idea, this table is for you. This looks at the long-term data, like the GDP, the unemployment, the interest rate, the CPI, the real yield. Real yield is, by the way, the interest rate minus inflation. It has to do with the interest rate that the central bank sets and with inflation. Then you get the real yield. So even though the interest rate in Japan is 0.75, inflation in Japan is current CPI. Let's take a look. Current CPI inflation is 2.9. So with that, you get the real yield. Real yield. You get this. That's your real yield. So it's the current bank rate minus the inflation. So it's still negative, which means you can still buy the dollar because you get a positive real yield, and you can sell the yen, you get a negative real yield, and you make money. You make positive swaps. So it's still a valid trade idea. And that's why, because the BOJ was dovish, because they don't want to commit to future rate hikes, the market interpreted that as being dovish, and they bought the dollar, they sold the yen. Let me show you. USD JPY. See, this happened on Friday. This was the immediate reaction from the BOJ. This was the BOJ. This was the explosion higher. So the carry trade, it's called the carry trade, and a lot of big money, a lot of big funds execute this position. The carry trade is still in play, which it was one of my fears that there was going to be a carry trade unwind like we had in July 2024. If a carry trade unwind happens, you get a massive sell-off on the dollar and a massive buy on the yen. So UJ shoots lower. It affects every currency pair, basically everything connected to the dollar and everything connected to the yen, because there's so much money parked into buying the dollar and selling the yen right now. So if we get a carry trade unwind, it's a bit of a problem. But we didn't get it. We actually got the opposite effect. We got even more strength in USD JPY. If it doesn't make sense, by the way, I know it's a bit complicated. Put a comment in the comment section and I'll try to explain it a bit better. Because it gets pretty complicated with these interest rates, like the nominal yield, the real yield, and then you have to account for inflation and this and that. Okay, so now time for the comments. Let's see. Let me see. Ball out. Hello, welcome to the stream. You can trade mud in Dubai. Thailand is where it's at. You can trade everywhere from Dubai. Hello, Nick. Which prop firm would you advise? So here at A1, we are partnered with DNA. If you're looking to get funded with DNA, you can use our discount code A1 Live to get 25% off. If you maybe didn't catch this before in the stream, so A1 Live gets you 25% off any DNA funded challenge. I personally use them, didn't have issues so far, so that's what we recommend. What's your opinion on USD CAD? Okay, sure, we can do USD CAD. Marco, check Aussie Yen. NZD USD, let's go. That's what I'm saying as well. What's your opinion on USD CAD? Okay, we can cover USD CAD. AJ, can you break down the gold chart? What's your opinion on USD? NZD CAD. How much do the challenges cost though? Just go to the website, just type in DNA funded and DNA funded. This is it. Okay, just go to the website and you can see the price here. And then once you go to the checkout page, you put in the code A1 Live and you get the price for you guys with the code. It's not that tough. If you cannot navigate to the prop firm website, then maybe you should not take a challenge. I mean, you should definitely not take a challenge. Can you please break down gold? Any clue about silver? Aussie. Hey, Marco, Euro Aussie shorts. Giveaway. I'm sorry, I don't have a giveaway for you today. We did have a few giveaways. I think it was 1 month ago. It was pretty fun. So maybe we will do more of them in 26. We will definitely do more of them. BTC. Intervention from Japan is still a risk. Yes. So that's a good thing to point out. If you look at UJ, we could possibly get, just a second. We could possibly get an intervention from the BOJ. Now, what are the levels? Why would they do an intervention? They do an intervention. They already had a couple of times when they did an intervention. If you Google it, if you ask Google Gemini or ChatGPT, it's going to list the exact dates when the BOJ already did an intervention. But one confirmed date was in July of 2024. You can see those levels. We are pretty close to those levels. I would say if we go back to 160 or above, we are in the intervention level zone. Now, the BOJ likes to do an intervention to control the sort of the exchange rate, or just to maybe help out their economy, help out their citizens, and just sort of, take control of the markets. So they like to manipulate the markets in the background a bit by doing interventions. Why does it matter for us as traders? Well, it matters for us because if you're in a buy position on USD Yen or any other JPY pair, and we are in the intervention level, you could get crushed. You could see a sudden spike in volatility. They love to do this stuff when there's low volatility, when no one expects it, when there's when there is bad dollar news, especially, because then they just pile on with selling the dollar and buying the yen. Their goal is for this to happen. In some cases not. But essentially, when there's an intervention, UJ most likely goes down. Okay, most likely goes down. So you should be careful. If you're in a buy position or looking to take a buy position, I personally would close everything in the area 160 and above. 160 and above is kind of the danger zone. Not financial advice, but that is just something that I would be doing, and that is just something that the traders that I follow would do as well. So that's the intervention level, 160 or above. We are approaching it. We could hit it in January, February. I think it could definitely happen. Are you a day trader or a swing trader? I'm a swing trader, but I do have some sort of experimental scalps here and there. For example, my last sort of a more of an experimental trade. This was not a signal in the A1 Discord because it's just something I'm experimenting with, was the euro and the Swedish krona. There's a very, very popular seasonality occurrence where the Swedish krona loses value from the 1st to the 15th of December, and then gains a bunch of value from the 15th of December to the 31st. The first position failed. I got stopped out, but the second position seems to be working out so far. It's a very, very popular seasonality pattern. It has to do with Swedish pension funds. I'm not going to go too deep into it, but yeah, this is very small risk, just experimenting with it. So far, one trade was a loss, second trade running in some profit, and this was more of a kind of a quicker position, you can say, than my other positions, because I'm definitely going to close this before the 31st. I'm not holding it in January. But my best trades are swing trades, like the one on NZD-USD, like the one on AUD-USD, like the silver position that I had, which unfortunately I got stopped out prematurely, but that was a swing position. My game plan was to trail my stop loss as the price keeps going higher. Merry Christmas, Marco. Merry Christmas to you as well, Pugs. Gold chart. Congrats on NZD-USD, Marco. I was kicked out just before the move. Yeah, I think I saw your signal, Nick, for NZD-USD, and it just went a little bit lower. So far, it's working for me. I usually prefer to take things around the 20 MA, so I waited for a bit of a deeper retrace. But yeah, at the end of the day, a few pips don't really matter for all of you that are watching this. You're never going to be able to time your entry perfectly. Sometimes you'll get taken out prematurely. Sometimes you'll get a perfect entry. Sometimes price won't even tag you in. It's all about having a little bit of luck here and there. But as long as you are right on most of your trades, or if you have, let's say, a positive reward to risk and you have a 50% win rate, you're going to make money. Or if your win rate is 65%, 1-to-1 reward to risk, you're going to make money. It's all about the large sample size. Aussie yen, short USD CAD. The amount of times that we got Aussie yen on this stream is amazing. So I'm going to do Aussie yen, right? Because you're just so persistent, I have to do it. Let's check it out. Aussie yen. All of the JPY pairs are heavily going higher. So all of them are heavily pumping higher, which is to be expected with the forward guidance from the Bank of Japan, with them being more dovish than people expect. They just don't care about inflation. What the experts say on the BOJ is they say BOJ is not an inflation fighting institution. They are an institution that wants to keep the carry trade going. They also want to keep interest rates low, right? For their debt. So most people, most traders say, the ones that know something, they say that the BOJ is really not that interested to fight inflation, while inflation is pretty high in Japan. See, pretty high inflation. It was even higher. Fortunately, it went a bit lower lately. What is my forecast for Aussie yen? It's bullish. Let me check the Edge Finder top setups. Let's see. The JPY. So bullish reading on the Edge Finder, which is always nice to see. A big confluence for me to be looking for buy setups. For the Aussie, I'm bullish in 2026. I already have a position in. The big banks are super bullish as well. They're going to pile into the Aussie in January, or at least the probabilities are telling us that they will pile into the Aussie in January. I'm not looking to add another buy position on the Aussie. So I'm in Aussie dollar. It's kind of approaching the year's end. I'm not looking to have massive exposure going into the new year. I'm not so certain in the yen, so I don't have a huge amount of confidence in the yen, as I have more confidence in the dollar, because there's the interest rate divergence, because RBA, RBNZ, ECB, like most central banks, even the Bank of Japan at the end of the day, most central banks are planning to hike interest rates in 2026. Well, the Fed is the only one which is confirmed, or kind of confirmed, most likely to cut rates in 2026. So I think that's the perfect storm. Aussie yen just doesn't give me enough confidence to get in. Maybe if I wasn't already in AUD USD, I would be looking to take Aussie yen. But if you are looking to take it, I would say get in around the 20 MA. Don't get in at the all-time or here chasing the highs. much better. You have a much better reward to risk if you wait for a bit of a pullback, a bit of a correction. You can see we are moving in a sort of a channel-like formation. So sort of a channel-like pattern. So we're going to go back to the trend line. Sooner or later, we're going to go back to the trend line, back to the 20 MA, and you'll be able to catch a bit of a discount, a bit of a cheaper price. If you could break down gold on a lower time frame and then bigger time frame. I don't really want to do that because I don't think there's a massive trading edge behind looking at technical analysis on the short-term timeframes on gold. I think the daily gives you all of the information that you need. So just a quick summary on the daily chart, if you maybe just joined. I'm bullish on gold. Edgefinder is bullish. I'm looking for buy setups. All-time highs. Daily chart looks great. Doesn't look crazy, doesn't look super impulsive, doesn't look like a bubble, doesn't look like silver, doesn't look like Bitcoin. So that's another plus in my book. I'm just looking for a bit of a pullback. I'm looking for a bit of a correction to the 20 MA, and then I would consider getting in on some nice buy setups. So looking for a bit of a pullback. I have an alert set. Will it happen in this year? Not sure. But if it happens, I'll take a position. I don't mind it. I don't mind the extra exposure. I think it's a good position. That's my game plan. Is coal done going up? Interest rates expectations for dovish or hawkish are priced in the present. What is expected for the future? What determines the value it should have in the present? I know it may be complicated. So interest rates are pretty complicated. For interest rate expectations, for the US dollar at least, you have a great website you can use, which is the Fed Watch tool, CME. It gives you what is priced into the markets because there's already today some traders betting on how many rate cuts there will be in 2026. So they extract the data and they publish it here on this website. So this tells you everything you need to know about the Fed. Currently, you have priced in 2 rate cuts of 25 basis points in 2026. Now, I wish there was a website like this for every currency and for every central bank. Unfortunately, there's not. So you have to have some sort of a proprietary software that's going to tell you what are the probabilities of a rate cut or a rate hike in the upcoming year. Now, what I can tell you right now, if I go through the list of currencies, let me go to the just a second. Real yield. Fed is cutting, or this is most likely to happen. The probabilities right now are that the Fed cuts, that England, not sure about England, they have to do some more research, but ECB could hike, Aussie hikes, New Zealand dollar hikes, CAD could actually cut, I believe. But I'm going to have to do more research, and the Bank of Japan more likely to hike than to cut. So I would say they're going to be hiking, not cutting. Okay. The most confidence I have around the Aussie, around the NZD, and around the ECB. And around the Fed, if I'm being honest. I do think rate cuts are coming. So it's about what is priced in. And if you're looking at interest rate decisions, if you're looking at central bank events, it's not about the number. If the number comes out the same as the forecast, it's all about the conference and the small print. What are they expecting for 2026? What is priced in for 2026? Or sorry, what is the forward guidance for 2026? For example, look at the latest report. So we had a rate hike for the BOJ, same as the forecast. Forecast was 0.75. We came in the same as the forecast. But the forward guidance was dovish. So because the forward guidance was dovish, UJ or the yen lost value. See, yen lost value because it's all about the forward guidance. Stop using smaller time frames. You'll be an easy meal to the gold market. I would also say to focus on the higher time frames, especially if you're a new trader. You're gonna have it so much easier, so much more simple. Your edge is so much bigger if you just focus on the bigger time frames and you focus on buying, not selling gold, because in the long term it just goes up. Your edge is great if you keep buying gold. Your edge is also great if you buy the S&P or buy the Nasdaq. If you sell gold, sell the Nasdaq, sell the S&P, you automatically have a negative edge. The probabilities are automatically stacked against you. It's almost like you went into a casino. I mean, there are traders who can make money selling gold, but there's so few of them, you can count them on the fingers on your hand, basically, because it's really tough. But what's easy is going up a time frame to the 4-hour, the daily, maybe even the weekly, and focus on buying the dips. Bloomberg Japan also reposting the Katayama interview of verbal jawbone to make it meaningful. Okay, I'm not sure what that means, but I'm guessing it's a bit dovish. Thank you, Nick. So hopefully gold starts skyrocketing again soon. If not, my account might blow. Risk management. Close the trade immediately. If you're not sure why you're in the position, if you're close to blowing your account, if you don't know what's happening, close the trade immediately. Not financial advice, but please be careful what you're doing in the markets and apply strict risk management. First advice, close the trade. Second advice, don't look to sell gold if you're a beginner. Third advice, risk management? Or was that the first one? I got a bit lost. So Nick says, I would encourage you to consider switching to demo if a small move lower in gold causes your account to blow. Something is off. Yeah, absolutely. Be very careful. I mean, this is a nice bull market. Silver could blow up any day. Silver looks crazy, but gold, it can just keep grinding like this. Especially, we're expecting inflation to go up in 2026. Trump's big, beautiful bill, Fed rate cuts, printing, spending. Trump wants to spend. Gold will, I mean, there's a very high chance that gold will go up in 2026. So that's my bet. I just want to get in. Give me a pullback so I can get in and get in on the uptrend. That is about it from me. I have approached the end of my segment. Thank you very much for watching. If you want to know when I'll be streaming this week, you can find me on the A1 live stream schedule. So this week, I believe I'm streaming today, of course, tomorrow, and on Friday. So these are the times when I will be on. Thank you very much for watching. Good luck in the markets, and Merry Christmas. See you in the next one.
Thank you for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want to get put on the nice list this year? Then make sure you check out the A1 Stock Box. That's all for today, everyone. We'll see you tomorrow. Ho, 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 ho.